Hello, you should be watching this series of videos if you have an asset that you bought over a year ago that is highly appreciated. These assets are typically things like real estate or a business, or frankly, one of my favorite things lately is cryptocurrency. And it could be also an art collection or anything that has appreciated in value and has a capital gains tax impact if you're going to sell it. So if you've owned it for over a year and your gain in that property, that asset is over $1.5 million, your capital gains tax exposure is over $500,000, and your proceeds pre-tax are $3 million or more, you should be watching this video series. What I'm going to be talking about is a strategy for you to defer and manage those capital gains taxes over time. And if you have any questions about this, there's going to be an opportunity for you to get on a 15-minute phone call with me, and let's just have a conversation about whether or not it makes sense. I want to be really clear that this strategy is a tool in my toolbox. Really, if this does not work for you in the context of your overall financial plan, you shouldn't be doing it. And so that's what we need to talk about first and foremost. But let's go ahead and talk about what the strategy is so you can understand it. I'm going to go ahead and share my screen. So the first thing I want to do is talk about what the particular calculations that I just said are, so you understand that we're all on the same page. I want to talk about some solutions that maybe you've researched and don't like, and then I'm going to talk about one that you might. So let's just make sure we're on the same page with these two calculations. The first one is to calculate your gain on the sale of the asset. And to calculate that, you're going to take your sales price minus your transaction costs, minus the basis that you have in the asset, which you might have to consult your tax preparer to figure out. And that's going to give you your gain. It's this number that's used to calculate your capital gains taxes. And again, I would like to see you have at least $1.5 million in gain for us to talk about this particular strategy. The other calculation that needs to happen is around sales proceeds. This is different. This is sales price minus transaction costs and any liens against the asset, and that gives you your sales proceeds. Now, the proceeds are used to pay the taxes, but the tax calculation is based on this number, not the sales proceeds. And again, I want the net sales proceeds, net of transaction costs and liens, but before taxes, to be at about $3 million or more for it to be most beneficial for you. Once you have figured out the gain, you then want to do your calculation on taxes. So most of you at this level are going to have federal taxes between 15 and 20%. You're also going to be subject to the 3.8% federal surcharge. And depending on what state you're in, you're going to pay somewhere between 0 and 13.3% on that gain as well for your state, which means that you're going to be somewhere between 15 and 37% in taxes on that gain. And if you're selling a piece of real estate, any depreciation recapture tax could actually make this bigger. The experience that I'm having in my state is that some people's capital gains tax rates are actually higher than their earned income rates. So those folks that I'd really like to share this strategy with. So now that we've covered that, let's just to make sure that we've covered all our bases, some solutions that you've probably researched and maybe one that you haven't. So I think the first thing that you have to just be mindful of is that it actually might make sense just to sell the asset and pay the taxes. People are always trying to avoid taxes and they let the tax tail wag the dog. And I think that's the wrong way to go about this. I can make an argument that taxes are on sale right now and you should just pay the taxes. So an option, maybe not a preferred one, but an option. You can also donate this asset to charity, either as an outright gift or in one of the various permutations of the charitable remainder trust. Typically, if you've looked at this and you've decided against it, it's because you just don't have a charitable intent or there isn't anybody that you want to give it to, whatever it might be. The next thing that you want to think about is maybe doing a Delaware statutory trust. If you have property, you can do a 1031 exchange into a Delaware statutory trust. Most people don't like these because they don't like the inflexibility, the illiquidity, and the time commitment on those. It used to be that opportunity zones were a great way to defer capital gains taxes and then be able to walk away with that money tax free. But now that we're past 2021, the opportunity isn't as good. And so people are usually not using this strategy. You can certainly gift the asset to somebody in a lower tax bracket, but you need to watch the kiddie tax if you're giving it to your kid who's under 18 or a student under the age of 24, and figure out whether or not that strategy actually works. I've had people call me up, tell me that they're going to move to a state that doesn't have a capital gains tax. I, no kidding, have friends that moved to New Hampshire and own a business over the border in Vermont, but they have tons of capital gains and they wanted to have a capital gains tax-free state. So they live in New Hampshire rather than Vermont. You can certainly move out of the country to avoid capital gains taxes. I understand that Puerto Rico works. And if you are not a citizen of the US and you are here on a visa, so not just a permanent resident alien, but you are here on a visa, then I understand you can also move to other places and be able to defer capital gains taxes. And I understand Portugal is the place to be. You can also just avoid paying capital gains taxes. There are people taking this risk, and then you can just negotiate with the IRS and the state later. It's not what I recommend, and I would have you consider whether or not you look that good in jumpsuit orange. The one thing that you probably haven't thought about or have written off as something that wouldn't work is the installment sale. And that's really what we're going to talk about here. There's a classic one, there's a structured one, there's an intermediated one. And so I'm going to talk to you about what that looks like so that you can see whether or not this is something that you might want to consider. So let's move on to how that intermediated installment sales structure works.